Alright, I switched my Wi-Fi, so we should be good, and we should not have any lag. Yep, everything works. Alright, so today's FOMC, and I apologize for my tardiness, but as ICT once said, I don't work for you, so you have to deal with it. But it's okay. No one was in waiting anyway. So FOMC, we have a little bit of a weird one now. Today from 1800, like, only went up. So I think we are in for some retracement. I'd be surprised if we continue going higher. But one thing I am noting is, if let's just say we were to entertain lower prices, just by looking at this chart here, if we were to entertain lower prices, well, where is the breaker? Breaker would be here. Right. High, low, that took sell side liquidity, and then we have the the low. Sorry, no, that's the dealing range. This is the breaker. We have the low, high, and the lower low. All right, so this breaker was formed within this range. All right, so this breaker was all the way up into premium. Right, it made a very deep run on sell side, and then it completely balanced out this price range. And now, if we want to come back into the breaker, we're retracing into a premium of that dealing range. So I don't really like this breaker. If we were to go higher, it seems to be a little bit into the premium side, and maybe during this FOMC we can see this get inversed. And the other possibility is that we continue to run higher. I'm saying that is a possibility because the daily fair value gap on Thursday was completely balanced out with Friday, moving into this gap, refusing to leave a fair value gap. Sorry, not that gap, but the candle, refusing to leave a fair value gap. And we had an initial run on Tuesday lower, and then we came all the way back up. And so I don't like this. I don't like to see this. And I think that us going back into these inverse daily fair value gaps might be hinting that we want to go to a higher premium. What is higher? There's a volume imbalance on the daily chart. You go to the 4-hour chart, and that's the new day opening gap, right? And we also have on the regular trading hours, we already opened up and left a huge gap. We have a huge gap here, and we have a huge gap there. We don't need to fill these gaps, but I think one of these is to see which one we'll reach for, right? But that's basically what I have going in. So I am two-sided. Like I'm not just one-sided. I know today opened up and it only went higher, and so to see a retracement is going to be likely, but I'm not necessarily 100% counting on a reversal and then continuing to go lower, because as you see, we've taken the sell side and we've cleared the buy side, and so we've swept sort of this consolidation both sides of the liquidity, and therefore I see no reason to continue going lower other than the sell side liquidity down here, which can wait, to be honest. We also did finish a 20-day look ahead, so putting in a short-term low at around that 20-day point is possible, and that's why we might be seeing a bit more of a retracement towards more of an equilibrium point. Now on the hourly chart, right, if you have actually, let's go back to the 4-hour chart. Maybe 8-hour. Alright, let's see on the 8-hour, right? This order block, the down close candle that swept sell side, I don't know if I'm using that as an bullish order block and I'm wanting to see it support. You see it's still pretty high up into the premium side. Coming back, retracing into it, there's still a long way we can retrace deep into this area. And so just because we may see lower prices, that goes to like very low, but I mean, even then, I still wouldn't be 100% counting on a reversal. Anyways, let's go down to lower time frame and check out the 2 o'clock delivery. So the initial statement at 2 o'clock, usually it's a two-stage move. I see it says it all the time. It's a classic. FOMC 2 o'clock will run in one direction, and then the actual speech when Powell comes on will usually go in the opposite direction. So we're gonna have like a Judas swing. Not always, but sometimes. Hello Neko, how you doing? And if we were to go lower, let's just say if we were to go lower than the low and then the higher high. So this is something like this, right? And we have the breaker here. And so then our breaker would be this. I don't like this at all because the breakers, the end of the breaker is completely into a sell side liquidity pool, completely into a huge discount. And so if we're starting to trade into this breaker, if we assume that this will become a bearish breaker, we would be wanting to see this act as resistance the more we trade through it. The problem is the more we trade through it, the more discount we get, and so the weaker this breaker actually becomes. If, however, we had a breaker up here, a bearish breaker up here, it'd be much stronger because it'd give us a lot more room to move lower. And so I don't like, framing lower prices right now, but again, because all day has just went higher, I'm okay with framing those lower prices. I'm going to remain 50-50 or on the sidelines, just really watching. Neko said, I'm good, but unsure of the market. How about you? Yeah, I'm unsure too. Honestly, I know a lot of people are saying lower. Even I kind of want to go lower because we've only been going up today, but I think that this might be a short-term high, and we may try and go higher to reprice some of these new day opening gaps up here. So I'm being careful, basically. I'm not I'm not like 100% betting on a reversal lower, but I'm okay with seeing a retracement. If we want to retrace into this breaker or in this range a little bit, and then on the regular trading hours gap, there's this gap up here we could reach up into, and there's also the gap from this morning which could also be filled. But if you put a gun to my head, I would pick higher. I would pick price to continue going higher. Did my streaming software disconnect? It says I'm not getting any data. Okay, I'm back. Alright, I think my stream just buffered. I should be back. Okay, nice. Before we get to that 230, which is going to be the second stage, I want to look at the other markets. So the S&P is still pretty strong, and Dow is very strong. Wow. I don't know which one is stronger. Let me look at it side by side. For today at least, it's kind of clear that the Nasdaq is much stronger. Like you can see the Dow did kind of retrace in the morning, so no way. Alright. Yeah, the dollar still finding support on that bullish order block. The dollar is having a really tough time to run higher. Like whenever we consolidate like this on the dollar, we always have poor conditions. Some of the best trading I've ever had was when the dollar was trending, but it is the summer, so not really. Don't really care what happens to the dollar, other than this trending. Seems like we're gonna inverse this gap. Maybe it could only be reaching higher to the volume imbalance, or we still have that gap there, which is resisting the dollar. The bond market, bonds continuing to go higher. And the alright. So now we just wait. Neko, I did the video you asked about stop placement. I just need to upload it. I'll probably upload it tonight or tomorrow morning. But I think you'll like it. Yeah, I took a look at the trades you sent me. I went back to the days and what I was seeing in different time frames to get a clear picture. And I noticed something that was kind of you were right with like your bias often, but it's your timing and like how you're looking to get in, which is just dismissing something. I feel like you're getting in a little too late or too early, either too late or too early. But if you focus more on breakers, formation of breakers and where they are in terms of discount premium, I think you're gonna have a easier time finding those turtle soup entries, proper turtle soup entries. Like, I don't always turtle soup, like sell old highs and old lows, but I use it as like a reason to enter my trade. So if I see a turtle soup and then I see a fair value gap forming or an order block forming after a turtle soup, I'm going to use that to enter my trades. And the breaker, which helps form that turtle soup, it's important that you identify that breaker and use it properly within your trades, and then you're going to find, in my opinion, it's going to be maybe a bit easier. But we'll see. less than 5 minutes before Powell starts speaking. I'll probably try and listen in on his speech. I don't know if I'll talk about what he's saying, but if I listen to what he's saying, I'll probably end up talking about it. I'll try not to, but back here. Delete. So, first 30 minutes, kind of evident that we've made a move higher. And ICT does teach that usually first 30 minutes is the first stage and the second stage opposes it. And I've heard some people teach the third stage in the last hour, but honestly I don't really look at it like that. But yeah, we could get another run, to which I would be looking at the lows down here. So I'd be looking at this breaker. And then also measure the daily inverse fair value gap for good measure. See that 50%? It's very sensitive. $30 now. There you go. I mean, there's nothing really to look at. Like, it's not really doing anything that I look at and I'm like, oh, I see this idea, you know? It's just slowly climbing higher. There's not really much to talk about. It's gonna be a weird one. I mean, who thinks it's gonna move 600 points lower today? I mean, this looks like, if anything, it's a beginning to a higher retracement. That's why it's like I'm kind of bullish. Like I said, if I had to pick a side, I would be bullish today, even now, to these gaps up here, because the immediate rebalance failed. So why is there two of this? Oh my god. So because of all these open areas up here, right, I'm more so bullish today, but there's not really anything, like, it's already way in premium and it's not really anything interesting right now. However, we did just run out the current high and we seem to be rejecting it. So what I want to see is how fast are we going to be now. If we choose to go lower, are we going to use this as a breaker, right? High, low, and then higher high. We have a breaker from this low to that high, and then are we going to space away from the breaker, then use it, come back to it, use it as resistance, and then continue to target lower back to midnight open? So that's this. Wait, this is the wrong midnight open. Midnight opens here. Right, so I want to see if that's possible. And I don't think there's any new day opening gaps or anything. I wouldn't be shorting just yet, because we have these inverse fair value gaps there, so we could still be supported by any of these inverse fair value gaps. I swear he says the same thing every time. Alright, now we're at the question stage. He says the same thing every time. It's fucking crazy. Oh, a banger question. Hold on. After a quote, what he just said, somebody asked him, there's huge market expectations about a rate cut in September. Is this, what you say, is this something we can look forward to? And Powell said, we have made no decision to cut in September. We have made no decision in future meetings. So why is everyone going around saying there's an 88.2% chance the Fed will cut in September? I can play here actually. I just didn't know if anyone would be interested. Let me do that. Let me add the audio. Okay. So the interesting part is the question part as well. I'll play it from the question part, but just some context as to why I'm so interested in this, because I like monetary policy and a lot of the markets revolve around the interest rate, so I follow it very closely. I currently have a bet going on with a friend that if the Federal Reserve cuts in September, I have to put a bumper sticker on my car that says I love the Fed, which I don't, but I will have to until they stop cutting rates. However, if they don't cut rates, then my friend has to put a bumper sticker that says uneducated economist on his car. And well, it's gonna be funny. And he's a lot older than me too. He has real stores, franchises, and businesses. And it would be very funny if he gets a sticker that says uneducated economist on his car. And then he has to keep that sticker there until they start to cut the rates, which could be in a long time, right? Everyone in the past 2 years, they've all been trying to guess when the rate cuts are going to come. And last year, in 2023, in 2022, they expected 7 rate cuts in 2023. And then this year, they expected like 3 or 4 by the end of the year. They expected some in April, in January, and there were none at them. So then they said, oh, maybe in July. There were none in July. And they said, oh, okay, there's an 88.2% chance it's in September. So, you know, the reason why these interest rates are interesting is because the Federal Reserve is manipulating. It's almost like charts here. When everyone believes that these rates are going to go down so much, they start to factor in the fact that these rates are going to come. And so they start to buy houses, they start to do business deals. You know, they do a bunch of business as if there's a guarantee that the rates are coming down, which is low rates incentivizes borrowing, which is good for tech. And so if you have rumors of lower rates, you know, tech will usually go up, or, you know, more business houses will be bought and prices go up. It increases inflation, right? And this is how, when they say that they're going to cut, or they're thinking about cutting, they never said they would cut. Sometimes they say that we think we may cut. Then the news gets on that and they say, okay, if the Federal Reserve keeps seeing positive data, they're going to cut. But no one knows how positive the data needs to be. So just the fact that the market sees positive data, they automatically think the Fed will cut, and then they go on it and they jump on that idea, which gives the Fed exactly what they wanted to get from an actual rate cut. So they don't even have to cut the rates, and they get everything they need. They get people to push up inflation, create inflation, just by believing that the rates are going to go down. And so prices go up while the rates are up. United States dollar goes stronger. Foreign currencies grow weaker. Foreign currencies eventually have to cut their rates. And now you have higher rates with the dollar, lower rates with foreign currencies. Even though foreign currencies are riskier than the dollar still has better rates. All money is going to flow to the United States. The United States is going to become a tyranny, basically, in the global. And this is why countries are starting to move away from the US dollar, because they don't like this. Anyways, let's start listening. I rambled on long enough. Let's go to the question part. All right. Can you hear it? Can you confirm that you hear it? Were you able to hear that? I just want to make sure you can hear it. You should be able to hear it. I paused it, but I don't want to play it if you can't hear it. What the fuck? Alright, I'll use a different thing then. I'll add...
Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina. Wait, you don't hear
Gina Smilek from the New York Times.
I don't understand. You should be hearing it.
Entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So, on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent, so it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you
stress test?
Evolving outlook and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting is met, typically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Colby. Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out.
Hold on, you heard what she just said? Said that the analysts, all the top people with degrees and that were paid to just analyze these things, they all said that we see unemployment going down to 2.6%, and unemployment and CPI 2.6%, unemployment at 4%, and we're at that level. But they also, within that scope, saw 3 rate cuts, but we haven't had any of the rate cuts. So where are the rate cuts? What are they waiting for? They have everything they needed. It's the fact that people still think that the rate cuts are coming that's giving them the opportunity to keep these rates higher, while they're trying to basically sucker out a bunch of this hope for rate cuts out of people while having these high rates. And all this strengthens the US dollar globally. Like, more countries are going to put money into the US dollar because it has high rates. And other countries with these higher imports costs are forced to print more currency, devaluing their currency, eventually cutting their rates more. So even going into negative rates for some of them. And so the United States is going to be like that one currency in a pool of shit that's going to be on top. It's like the ring of power from the Lord of the Rings, the one to rule them all. And I mean, I think that Powell and Donald Trump are definitely in bed together, because if you look at Donald Trump's comments, I think Donald Trump wants this, and if he gets elected, he's gonna take this exact thing, this scenario, to a whole nother level. He's gonna put the imports up, the dollar is just gonna become insanely powerful, and then other countries are practically going to be enslaved to the United States. Yeah, the Fed is evil. I mean, it's been evil from the beginning. In 1800s, when the United States was formed, I mean, the third U.S. president said that we should not have a central bank. That if there was a central bank that controls the supply of a currency through inflation and deflation, that eventually it would lead to poverty. That the whole country would eventually be poor. And that's what you see. You see a bigger gap between the rich and the poor, because all the Fed does is they're there to serve the rich, to give the rich more power. Let's keep going, though.
Out in that June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one.
Well, Trump values conservative policies. No, he isn't a globalist. I think so, but look, what people say and what they do are always two different things, right? I could say, for example, that I'm the best analyst in the world, but if I never show it, I prefer to show it and let other people say what they want. And when I look at what Trump said, his comments, I don't see this sort of non-globalist, conservative person who wants to go back to the old values. I mean, okay, when he was president and you had this scenario where there was low inflation and there was high interest rates. No, sorry, very low interest rates and low inflation. The Federal Reserve, usually what happens when they're at that scenario is they can't lower their interest rates anymore because they're already at zero. So the only way they can get the gunpowder, you can think of it as gunpowder, back to have higher rates, so that in case of an economic slowdown, they have the ability to lower the rates, right? And the only way to get that back is if inflation picks up, because then inflation goes up, then they have a reason to higher the rates. Eventually there's a crisis, and it's a typical inflation, deflation cycle, where they raise the rates and then they lower the rates, raise the rates, lower the rates. But they can't do that if the rates are at zero and there's no inflation, no unemployment. So they needed a reason to have unemployment and inflation. Then COVID happened, conveniently. I'm not saying COVID was planned by the Fed, but I'm just saying that COVID saved the Federal Reserve. If you look into this is something that a lot of people agree on, that I've been able to say, and no one calls me crazy for that, because everyone kind of understands why COVID saved the Fed, right? To say that the Fed did COVID on purpose may be a bit crazy. Maybe it's possible, maybe it's not. Doesn't matter. The truth is that, the COVID allowed the Federal Reserve to print money and put up inflation. What Trump was saying ahead of COVID was that the Federal Reserve should be printing money and putting the rates to negative, because other countries had to put rates to negative during that time. And so he says that there's no inflation. The Federal Reserve should be printing money and putting rates to negative. What does that do? Negative rates causes inflation, and printing money is inflation. And so what you have is you're going to have hyperinflation, basically. Trump was calling for inflation. He wanted inflation. And the Federal Reserve was saying the same thing. If you look at their 2018 speeches on the monetary policy strategies in a low interest rate world and a low inflation world, because that's the problem they had. In 2018, they were talking about this problem that they had where they had low interest rate and low inflation. They needed a reason to have high inflation, high interest rates. And then in 2021, in August, after COVID, Powell came out and said that they would aim to have interest rates, inflation moderately above 2% for some time, right? Because they wanted high inflation so they could have high rates. And then they have gunpowder to cut rates if ever they need to in the future, in case of an emergency. But you see, Trump now switched up. Now that there's high rates, now he's saying that the Fed shouldn't cut the rates. So you see how they're playing with people. The rates will only go down when people start to believe that they're going to go up or they're not going to go down. That's when the rates are going to go down, because people won't be giving that effect that they believe the rates will come down, so they'll keep buying and pushing up with inflation. So once this is why I say it's a lot like trading, is that like the moment people stop to believe that the rates are going to come down and they stop doing business and they stop pushing up inflation, then the Federal Reserve might cut once or twice, get people excited again, get people buying and selling again. Then they might wait a little bit and try and cut at a pace. And all this is, there's a bigger narrative going on in the back, which I'm still trying to wrap my head around, but Trump is playing into this, because what he said before is Fed should have rates, negative rates, high inflation. Now he's saying Fed shouldn't cut the rates. It'd be a bad deal if they cut the rates. And the reason why is because if the Federal Reserve cut the rates, they're going to leave Trump with worse off in the economy when he gets into presidency. So I think that the Fed and Trump are kind of working together, and and Trump wants to put up import prices. If Trump was a conservative, he would not want to put up import prices. He would want to let the kind of market deal with that, and instead of enforcing fees on things. But all this is he has one goal: strengthen the U.S. dollar, make the United States stronger as a country and as a currency. That's the Fed's goal too. Like he's a businessman, and he's working with the Fed in order to get this done. And it's working. It's working very well. And we'll see if he gets into presidency or not. But if he gets into presidency, what I'm talking about here, as the United States being kind of like on the top of the world, they're only going to get stronger. And it's only going to become worse for these other countries, which is a really good thing for the United States. But not good for the rest of the world.
At the September meeting, I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Conservatism is protecting domestic industry mostly through lack of import. Yeah. Yeah, so you're saying that Trump is going to want to you're saying he's going to want to produce and export more? Because the United States isn't going to import less. They could look into exporting more, but they're not going to import less. You would be asking to destroy the standard of living of lots of rich people, which unfortunately basically buy these political parties. I mean, if you put high tariffs on imports and exports, so like countries have to pay more US dollars to get your stuff, that would decrease imports, but that also that might not necessarily decrease imports. That might just create more inflation and higher prices for people, and cause other countries to print more currency. So like it's not it's not a like the United States doesn't have a very big domestic industry. It's hard to be conservative when you can't really produce much. So like if you think of how the United States gets all their stuff, like yes, the United States can grow a lot of food and can export lots of food, but they don't do it the most they could because they import a lot of things. And that's because countries, they send them currencies, foreign currencies, and the United States just prints their money and sends it back, and they can do that as much as they want because other countries will continue to use the US dollar. If, however, Trump was to find a way to focus more on producing domestically, and then now they stop sending currency to these other countries, and instead they send them a product, then that would be conservative. But I think I don't know if he's necessarily talking about doing that. I think so. Under Trump, USA was, for example, the first time in history an oil exporter. Trump tariff for steel was 25%, for the rest 10%. Yeah, I think Trump just wants to get more out of our stuff. Like we have oil, why not export it? And then he wants to put up tariffs on certain things like steel. But that doesn't mean that we're gonna start to have a stronger domestic industry. I don't see how the United States could have a stronger domestic industry. There's already so many people living in the United States, and there is no incentive really or opportunity to go ahead and grow a domestic industry, since it's more profitable to get stuff from foreign countries. I'm talking about stuff like food and all the basic living every day, the cars, clothes. We all get them still from China and other countries. Oh, let me resume the Fed.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market too? If the labor market is back in equilibrium and potentially very restrictive policy given the high real funds rate warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates, and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions, and that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past you've said that stronger growth wouldn't override better news on inflation. I wonder.
Hold on. Yeah, I understand how you would think the interest rates would be if a Democrat nominee won. Okay. If the Federal Reserve started to lower interest rates now, that would be seen as good. And I think Trump would like some of that. So if Trump gets into office, it's hard to say really, because the Federal Reserve, isn't political. They don't pick sides. They're just focusing on strengthening the US dollar and getting them their monetary policy back, because if people realize they have no monetary policy, there's no reason to have a Federal Reserve. And so that's one reason COVID could have happened, to give the Federal Reserve the ability to have their interest rate monetary policy back, and then to strengthen US dollar with this high interest rate and a belief. And ask everything I'm saying, ask ChatGPT about this monetary policy, and ChatGPT literally describes it very well. Exactly what I'm describing. It's a strategy because it's been talked about by the Federal Reserve in their speeches, and so ChatGPT is going to be able to tell you more about this. If you want to, on your own time, if you want to ask questions about how it would work and scenarios and what if scenarios. But it's hard to say, because when a Democrat gets in, and if people still think interest rates are going down, it's going to know what the Federal Reserve is doing, and if anything, they're going to try and support it. It's going to be the political leaders that are going to be supporting the Federal Reserve, not the Federal Reserve supporting the political leaders. Because what the Federal Reserve is doing right now is ultimately strengthening the US dollar, making it kind of like on top of the world. And it's good for anyone in office, really, that this is happening. Except for Biden's office, because you see, Biden's economic team actually said that this was a problem, that the United States dollar was the global reserve currency, and that but they said that the only way we could actually get off this reserve standard is if, and only if, other countries stopped using US dollar. And if that happens, then we can start to repay debt. They can start to repay their debts in US dollars to other countries, and then we could slowly start to move away from having a global reserve, dollar status. Because these other countries are in so much debt, United States dollars, to these other countries that aren't the United States, that the way they pay it off is by borrowing more United States dollars. And so the United States is basically on this debt path that you could argue is sustainable or unsustainable. Some could say it's too big to fail. But one thing that's for sure is that eventually more and more countries are going to get fed up, and they're going to try and, like we were already seeing with Russia and China and the BRICS, they're going to try and move away from the dollar. And what China's doing right now is very smart, actually. They're loaning a lot of US dollars because they know that US dollars may soon become scarce as the United States just goes in bigger and bigger debt. And then whenever that happens, if it happens, they're going to have a bunch of these assets owed to them in US dollars, and that's going to be very good for them because United States dollars are going to be scarce. So the price is going to go up. It's going to get stronger. Everyone's going to want them. So the United States, the yuan could eventually then get pegged to the United States dollar, and then the yuan can start to supply because they have this much asset in US dollar, until eventually you switch from US dollar to yuan. It's kind of like what China is trying to do, and it could be a threat to the United States.
How that cuts the other.
If you want to learn more about the weak domestic industry, you should read about Cantillon's effect. It refers to uneven distribution of newly created money within an economy. And so when new money comes in from foreign countries, it pushes the old money, the domestic money, out. And then there's less reasons for manufacturers and producers to set up shop in the United States. Like, why do you think Apple produces their phones outside the United States? Because it's cheaper for them. It's way cheaper for them to set up shop somewhere else. Same thing with a lot of other big tech companies in North America. It's less convenient for them to produce in the United States because of the high cost of living. They would need to pay their workers more because of the minimum wage, which is unaffordable for a lot of businesses and less profitable. And so the only way you would get what Trump... Cantillon is... Here, I'll type it in the chat. The only way you would get this effect where Trump comes in and he strengthens the conservative values of the domestic industry, and domestically the United States gets stronger, is if you reduce the standard of living of people. So people, all of a sudden, they lose their luxurious privileges, and they're willing to eat lower quality food, or stop getting new good clothing, new jewelry, new everything. And all of a sudden this gap between rich and poor gets smaller. But I don't see that happening. I wish it could happen. I mean, it should happen. Unfortunately, the rich aren't going to give up their standard of living, and it's the rich that own these political parties. Oh, and Gresham's Law is another good one too. You should check out Gresham's Law with Cantillon's effect. Gresham's Law is a principle that states that bad money drives out good money in currency markets. So the bad money would be the foreign money, which drives out gets the United States to export the good money, which is the United States dollar. So people are stuck with more foreign products instead of United States dollars. This is why people can't afford homes or, food. Because the minimum wage goes up faster and the cost of living goes up faster than the actual wages of real specialized job that usually pays above minimum wage.
Other way, if you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have two mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those two things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things surveys, quits,
I watched an educated
hires, all of
economist.
those things to determine the
See if you
overall
can.
status of the labor market. But we're looking at it now. I would say, again, I think you're back to conditions that
Simon
are
in his car.
close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think inflation was actually, core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris Rugaber, Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent, if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this, and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of, I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these two.
Because what he says is basically against everyone. The thing is that he barely graduated high school, and he works in the lumber industry, and he just read a lot about the Federal Reserve and the economy, and it was kind of like a hobby he picked up, and so he knows so much stuff about domestic, economy. It's just crazy. But I started reading Cantillion's essay, which is a book. It's a lot of where he gets a lot of his knowledge from his books. And one of them is Cantillion's essay. It was written in one of the first books on economics for entrepreneurs. The first book, actually, for entrepreneurs and economics, written in 1730. So, like 300 years ago. And it's a really good book. It's free, too, on the Mises Institute.
Two risks of go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates, and I think this is how we balance them. It's a rough balance, but it does feel like, again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low, and we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even
Almost
below
everything.
2019 levels. Layoffs remain.
It's always like that. Follow the crowd. Like the Judas the goat that led all the other sheep to the barn. You're gonna get slaughtered.
Remain low, so it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected, so that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, one rate cut wouldn't do anything. So I wonder if you can, sort of follow on Colby's question, talk about, are you weighing the economy right now in terms of its ability to withstand one rate cut, or are you in the process now thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen significant movement in the labor market, and we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So we actually got to this. We raised rates a year ago at the July meeting, and if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market has, I think, unemployment was in the mid threes. So it's a different economy. I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is,
So what he's saying here, it's coming to be time to adjust to this new economy. That's exactly what the type of words that he says that gets people into the markets and that gets people on the media to put out this propaganda and says the Fed are cutting rates, because you hear him say stuff like this. It's coming to that time until people actually stop believing in this fallacy that the Fed are going to lower rates. Once people stop believing that, then the time's going to be there to lower the rates. But he keeps saying, he's not saying we're not going to lower the rates. He's saying that, oh, we're getting there. You know, a different way of saying it every time, but says it out of the way. Well, sorry, it doesn't say it out of the way. Like, it's just, I don't understand. You go on the news and you see all the propaganda about cutting rates, and no one ever said, you know, all the FOMC members, if you look at their individual speeches, like Waller, like as example, the recent one from Waller, he only had higher expectations for inflation. He said it's more likely we're going to see inflation go up because of these reasons. He mentioned global wars, you know, global conflicts. He mentioned supply lines globally. He mentioned certain factors about unemployment and inflation too, domestically. And he said that, you know, I have almost no hope for lower inflation. I almost all have higher inflation risks. So you go to these individual members and you'll see that if ever, you know, somebody sues them and has a case against them because they kept saying that they were going to lower the rates, which they didn't say, they'll be able to go and show the speeches and say that every single one of us had higher inflation expectations, which they had since 2021, moderately above 2%. And so they had no reason to put the rates down. They wanted to be confident that all the risks would be gone. But also, with this belief, while they're here, they're going to make people believe that they're going to come down. And I don't know if that's the Fed that's doing it, or it's the media that's putting out this propaganda purposely. I don't know. Maybe the media is just stupid. But one thing is for sure is that they're not cutting the rates. Somebody's not telling the truth here. And we're having a bit of interesting price. If price is going to do something, it's now in this 15.50. I've been watching price and, you know, seeing nothing happen. We came up, took out this short-term high there, initial run lower, higher high. And so we could get an inverse fair value gap. And if that happens, if we inverse this gap, I don't see anything stopping us from coming down a little lower. So I'd like to see if that's the case. We kind of had a huge drop there. But it's really slow FOMC kind of. Like it's August FOMC. No one really expected anything to happen until September. Some people were actually saying that the Federal Reserve was going to cut before September and August last month. And I'm just like, what the heck? And some of these people that were saying this I have been listening to for a while about the economy. Yeah, we seem to be inverse in that. We're only 10 minutes in though, so maybe it's a big wick. So we'll be looking at that wick, constant encroachment. And then constant encroachment 50% here of the daily inverse fair value gap. But like I would not be looking to go short off of this. Right? One, we have relative equal highs. That didn't really get swept. Then we also have just higher price action all day. So we're probably just going to not really do anything. No, I'm definitely not participating. I thought like that was kind of clear from the beginning. I mean, look at that was clear from this morning when I said fuck this price action. I got up at 9. Well, not got up. I got on the charts at 9, and I saw just this. only higher price action. I'm just like, what the fuck is this? I just didn't want to trade it. No, I'm buffering. Hold on, give me 1 second. Yeah, look. This is what I said in the morning at 9:05. I said, for real, fuck this PA. Like, this is all I saw. It was just going higher. Why would I want to participate on anything here? I mean, if price retraced at 9:30, then maybe FOMC can do something. But the fact that even ahead of FOMC, price did not retrace. It just continued to go higher. It barely retraced at 13 o'clock. This is very shit price action. I mean, tomorrow might not be good either, because we have NFP on Friday and we expanded all day today, so we might see a bit of consolidation. And then Friday might see a manipulation, higher or lower, and then the other direction the rest of the day. I think if you want to wait for a really good trade setup, you're best to wait for Friday. Tomorrow would probably be better for scalps. But other than that, I don't think there is much else to talk about. I mean, I'm just looking at how this candle will close into 345. Wait, this is the hourly chart. So we're not inversing it yet. Hey, if we didn't have relative equal highs up here, I would have probably preferred to participate. And let me just look at these other markets. Wow, and the Dow today seems to be moving a lot better than the Nasdaq. I mean, it looks pretty good, to be honest. Gold is absolutely killing it. And the dollar's starting to draw lower, which is what? Harder for indices to go lower. So you would be trading as the dollar is going lower. Which means for, until the dollar really starts to show it wants to go higher, honestly, I would be having it, I know it's going to cease to go higher. And bonds are all higher. Everything's higher, except for the dollar. Yeah, bonds is kind of clear. It went higher a lot. This is interesting. I wonder if the yield curve changed at all. Yeah, the day before NFP is a weird one too, just like yesterday. Oh wait, I gotta go on the line chart. Guess these haven't really changed. Okay. Well, probably gonna get off now. unless something crazy just happened. 100-point move. But for tomorrow, at least, let me just say what I think for tomorrow. For tomorrow, I think we'll probably end up seeing what I'd like to end up seeing. This is, I have to wait until midnight open and New York session in order to determine exactly what's going to happen. But if I just look at this price action, what I'd like to see is maybe a little bit of a consolidation, maybe edging a little higher. And then I want to see, you know, Friday, maybe NFP make a run up, and then maybe do something like this and retrace into the week's range. But I still have higher upside potential for today, because for this week, because, you know, like I mentioned, if you go up on the daily chart, we've got that volume imbalance, which just looks too big and too nice and juicy. Same a new day opening gap too, it's the same one. And now on the regular trading hours, you have that big gap here and here. I don't know if it's going to come up there, but there's lots of things that would be leading me to believe where we could see a deeper retracement. And maybe even, you know, honestly, I have a hard time saying this, but maybe even a complete reversal where we start to aim to make a new all-time high. Or maybe we come short of making a new all-time high and come all the way back up here in the 20